Hey everybody, today I'm talking about one of my favorite tax planning strategies that helps people not get killed in taxes in retirement.
Welcome to the Financial Pathway Podcast. We're here to help you go to the next level in your finances with practical advice from speaker and financial planner Nate Skeller.
So would you like some tax-free income in retirement? Who wouldn't, right? Well, today I'm going to tell you about one of the best strategies that's going to help you not get killed in taxes when you retire, and that strategy is called making Roth conversions, not to be confused with the backdoor Roth IRA. That's a different strategy. Roth conversions are a great way to do tax planning and to lower your overall tax liability. So here's a quick tip. Back in 2017, the Tax Cuts and Jobs Act, it temporarily reduced the income tax brackets. So right now, income tax brackets across the board are a little bit lower than what they were back in 2016, but those are set to expire at the end of 2025. They may get extended, they may not. We'll have to see. But especially because we're in this zone of time, at least right now as of this recording, where we've got some of the lowest tax brackets in recent history, right now may be a perfect time to go ahead and implement this tax saving strategy. So quick disclaimer, as always, please consult with a tax professional before implementing this kind of strategy. I am not giving you tax advice. Today's examples are for illustrative and educational purposes only. So let's start with, how does it work? What is a Roth conversion and how does that take place? Let's say that you have money in a traditional IRA account or a traditional 401k. That means that you're going to have to pay taxes on that money when you withdraw it in retirement. The tax deduction was given up front. When you put money into that account, you didn't have to pay taxes on it. Then you're going to pay taxes on it later when you take that money out. However, a lot of people don't know that you can actually convert some or all of that money to Roth by simply paying taxes on it now. And it's a simple process. If you have a traditional IRA, you simply transfer money to a Roth IRA and go ahead and pay taxes on that transfer in this tax year, typically when you file your taxes later on in April. You may be able to convert money in your traditional 401k as well. This can be a little bit more tricky. You can convert potentially a traditional 401k to a Roth 401k, but you're going to have to check with your 401k plan to see if they allow this. So let's say that your household income is $100,000. And let's say that you have $50,000 in a traditional IRA. What you can do is you can open a Roth IRA and then transfer that money that's in the traditional into the Roth IRA and pay taxes on that $50,000 for this year. And then when you file your taxes, you're going to add $50,000 as taxable income and pay taxes on your tax bracket for that year. So you can see how if you're doing that conversion, it's going to add to your taxable income and may even push some of that money into a higher tax bracket when it comes time to pay your taxes. But you don't have to convert the full amount. You don't have to necessarily take all the money that's in your traditional IRA or traditional 401k and convert it to Roth. You could do any amount. You could do $10, $20, $1,000. You pay taxes only on the money that was converted. They say, okay, well, what happens to that money after it's converted to a Roth IRA? Well, you just continue to invest that money like you had before. But now, when you reach retirement, you are able to withdraw the full amount tax-free, both what you transferred and then all of the growth that it has accrued over time. Now, why would you do this? You say, well, Nate, if I'm going to pay taxes anyway, why would I do a Roth conversion? Well, for a few reasons. Number one, basically because you want to pay the devil you know today. You already know what tax bracket you're in right now, or at least you can figure that out if you did a Roth conversion and add it to your current income, what tax bracket that would put you in. And if you think that you're likely to be in a higher tax bracket later, it can make sense to go ahead and pay taxes now as opposed to later. So for example, let's say you're currently in the 12% tax bracket. And let's say you're $10,000 away from going from the 12% tax bracket and now entering the 22% tax bracket. You may want to consider converting $10,000 from your traditional IRA into your Roth IRA and pay 12% tax on that now because you believe that the taxes on that withdrawal later are probably going to be higher. So in this situation, you may not want to do more than that because anything above $10,000 is going to be taxed now at 22%. You may be not as confident that your taxes are going to be quite as high as 22%, or at least might be close to that. So you would only do a Roth conversion on the 12% amount. Another reason why this could be a good idea is, or at least another benefit, is that once the money is in a Roth IRA, you won't have to take required minimum distributions in retirement. So, for instance, with required minimum distributions, the way that works is if you've put money into a traditional IRA or traditional 401k, you didn't pay taxes up front, you pay taxes later. And the IRS requires, right now it's once you turn 73 years old, once you reach a certain age, you have to start taking a minimum amount out each year. And the reason we do this is so that people cannot just keep money in their IRAs or their 401ks indefinitely and just build them and build them and build them and not take money out. The IRS wants to get tax revenue on that money. But a Roth IRA, you don't have a minimum distribution requirement. So for a lot of people, they get to retirement and maybe they've actually got enough money from other sources. They don't need to pull from their retirement accounts. But if they have traditional retirement accounts, they have to take out a certain amount. But if you have a Roth account, there is no required minimum distribution because you've already paid taxes and that money is going to come out tax-free. So the IRS is in no rush for you to take that money out. And the third reason is this. If you end up not needing this money, or at least not all of it, it can then pass on to your beneficiaries tax-free. If they inherit your traditional IRA, they're going to have to pay taxes on that money based on their tax bracket. So this might be another way to ensure that future inheritance is going to be able to go to your beneficiaries tax-free. Now, are there any considerations to keep in mind? What do we need to look out for or keep in mind when thinking about Roth conversions? Well, several things here. First of all, number one, prepare for a higher tax bill in years that you do the Roth. Because remember, you're choosing to pay the taxes on it now, so make sure that you have the funds to cover that payment so you're not going to get shocked in April when the tax bill comes due. Number two, remember that state income taxes might also apply. So factor that in. If you live in a state with no income tax, like Tennessee or Washington or Florida, well, that's not going to matter. But if you might move from or to a state with no state income tax, that's something else to consider with doing Roth conversions. So if you're moving from a state, like for instance, if you're going to move from New York to Florida in a few years, you may not want to do a Roth conversion yet, because if you wait until you're a Florida resident, you don't have state income tax on that. If you do a Roth conversion now, you have New York state income tax to deal with. Or vice versa. Let's say you're moving from Tennessee to California. Well, maybe you want to go ahead and do some Roth conversions now because it won't be as beneficial once you're in California. Third consideration to keep in mind is that doing a conversion will raise your taxable income and might affect what you qualify for. Things like health care or how much you pay on Social Security, how much tax you pay on Social Security. So just keep in mind that doing a Roth conversion may affect other aspects of your finances. This is why it's always good to talk to a tax professional and talk to a financial planner to make sure that all of those factors are being taken into consideration. And then fourthly, another important rule to keep in mind is the 5-year rule. What is that? Well, when you make a Roth IRA conversion, it starts a 5-year clock. If you withdraw from your Roth IRA within those 5 years, your earnings won't be tax-free. They're going to be taxable, and if you're under 59.5, it's also subject to a 10% IRS penalty. Now, if you're over 59.5, you will owe taxes, but not a penalty. In other words, this is not something that you want to just try to do a quick turnaround on necessarily. You want to plan this out well in advance so that you would avoid running into that situation. Your contributions to a Roth IRA can always be taken out tax-free. So if you put $10,000 in a Roth IRA, you can always take that right back out without taxes or penalty, but it's the growth that could be subject to taxes or a penalty. So, quick example, you're 50 years old, you did a $10,000 Roth conversion 2 years ago, and it's worth $12,000 now. If you withdraw the full amount, you owe taxes and a 10% penalty on the $2,000. the $10,000 original amount is not taxable. Okay, so let's talk quickly about how does this work in practice? Like in real life, when people want to do a Roth conversion, where might that make sense? You say, Nate, it sounds good. Where would be maybe some examples of times where that would be a really, really helpful strategy to implement? Okay, well, first of all, maybe a loss or change of a job, or one spouse stops working, or maybe you've started a business and you have a lower income or higher write-off expenses. Basically, any time where you, for whatever reason, are dipping into a lower tax bracket temporarily and expect for income to increase in the future, those are really good opportunities to do some Roth conversions because you can pay taxes at a lower amount and then be able to withdraw them tax-free later on when you are probably going to be in a higher tax bracket. So because of these life changes, your income, you may fall, you may end up in a different tax bracket. So for instance, instead of paying 32% on every new dollar of income you're making, maybe now you're only paying 22%. So if your income is likely to increase later on, it could make sense to go ahead and convert some of that money to Roth, pay taxes at 22%. Later on, you're in a higher tax bracket. Those withdrawals can come out tax-free. So if you are thinking about whether you should be doing Roth conversions or you'd like to see what that might look for you, feel free. You can always schedule a quick call with me on my website, nateskelly.com. Speak to your tax professional, speak to your financial planner. But hopefully this is a good strategy for you to keep in your back pocket, and it may come in handy come retirement time. Thanks as always for listening and for watching, and I've got some more retirement tax planning tips coming your way soon.